Hey guys, how's it going? It's Andy from Magoo Investing. Happy Friday. The past couple weeks I've been talking about a lot of stocks, and if there's any stock you guys would like me to go over in a future video, be sure to leave it in the comment section down below so I can get my creative juices flowing over the weekend and plan a week full of videos for next week. So a couple weeks ago I got a comment asking me to talk about leveraged ETFs, and for those of you that don't know, leveraged ETFs are an ETF that follows a certain stock, index, security. It just follows something and it moves 2, 3, or even 4 times what the underlying stock does. And so it's a way that you can make a lot of money very quickly, especially if you have something that you have a lot of faith in. And so in today's video, I'm going to be talking about the important things to know about trading leveraged ETFs, talk about some of the risks associated with them, because a lot of people think that buying into leveraged ETFs aren't that risky if you're just following the overall market and are a way to triple your money in just a single year. And I'm going to talk about my history trading leveraged ETFs and how I ended up losing 75% of my portfolio around 2 years ago and some of the lessons that I learned from that. And that will include me hopping on the computer and talking about some important things to remember if you are going to be trading these ETFs. So before we get started, I do have to say that I'm not a licensed financial advisor and this is not financial advice. Anything you hear in this video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, really appreciate it. Hit that like and subscribe button, as it would help my channel out a lot. With that out of the way, let's hop right into it and talk about leveraged ETFs. Are they good? Are they bad? Should you consider buying them in the future? So let's get right to it. So leveraged ETFs sounds a little bit too easy. So we know that on average, the stock market returns around 10% a year for the past century at this point. So if you're going to be buying into a triple leveraged ETF that follows, say, the NASDAQ, wouldn't it make sense that it goes up 30% when the overall market goes up 10? That makes sense to me. And then you think 30% a year, and then you hop onto a compounding interest calculator. You put in that you're going to be investing $1,000 a year for 42 years until you retire. And then it says that you're going to retire with $325 million. Sounds perfect, right? The problem is there are some complicated things that comes with the math for ETFs that makes it so it's not as surefire of a way of tripling your money, because if it was that easy, everyone would be doing it. Why would you just buy into an ETF that follows the market when you can follow one that is going to triple your money? And so the math that makes it so it doesn't follow the annual returns is the fact that these leveraged ETFs follows the daily move of whatever it's following and not the annual return. So even though the stock market on average returns 10% a year, the ETF isn't going to triple that number. It's going to follow the daily move. And on average, it's not going to be 3 times. For example, let's talk about the tech-heavy NASDAQ that's had an incredible 2020 so far. At this point, it's up 39% on the year. And the 3-time leverage bull ETF, which is TQQQ, which is going to be the one I'm going to talk about a lot in today's video, is up 94% on the year, which is, very good. It's almost doubled so far in this year. But it's not the same as the 117% you'd expect if it was following the actual annual move. And so the math that works out for it is that it's the daily move. And so a 10% move on one day does not equal a 10% move on the other day. It's not the same thing as a 10% move up equaling the same thing as a 10% move down. It's not something where you can just add them together. As the price changes, a 10% move is different on a different day. And so I found this graphic that kind of illustrates how that can change over just a couple days. And so the whole idea is that you start with $100 in an index and $100 in a triple leveraged ETF. The first day you get big news, the index falls 10%, so now the money that you had in the index is now worth $90. And since we have a leveraged ETF, it becomes a 30% move down, so you end up having $70 left in the leveraged ETF. That makes sense, it's triple whatever the daily move was. Now we get to day 2. The news was reversed and you have a jump of 15%. Now the index is up 3.5% from where it started, but instead of multiplying that by 3 and having $110.50 based off of what the actual index looks like, for the past 2 days, you're up only 1.5% total, because it is 3 times of that actual move. And the 10% move, even though it looks like it's going to be smaller than the 15% move that we just had, it actually is weighted more because the index was higher before that. So from day 2, you are down compared to just following the actual index. And you see that a lot. There are some examples that I've been finding recently following gold, where even though gold is actually up for the past couple of days and it's actually outperforming the triple leverage ETF, this is an example of the intraday move is super important for what these leverage ETFs do. Then you get to day 3 and you have a 5% move. The index is down 1.5% compared to the ETF. That is down almost 14%. So this is an example of volatility for a long-term position for a leverage ETF usually means tough times. So from this example, in just a couple of days, the index is down 1.7%. But instead of it being 3 times that, it's actually significantly more. And so instead of being down 1.7%, you're down 14% in just a couple days. And this is called decay, and it's something that you see a lot with these leverage ETFs. And it's a reason why I've always kind of stayed away from leverage ETFs for the past couple years, because even though it makes sense that, the stock market goes up 10% a year, a 3 times leverage ETF puts you at significantly more risk than pretty much anything else in the stock market. An example that I saw this had to do with oil. If you remember back in April, the crude prices fell down below $0 for the futures, and it made sense that if you thought crude was going to recover, to buy into a leverage ETF, because crude's going to have to get back up to where it was. And at this point, it has recovered significantly. It went from being at $0, and currently it's at $46 a barrel. And so the 3 times weighted bull ETF, UWT, is an ETF that's down 96% on the year, because that crash at the beginning was so significant that it made it so it was pretty much worthless. It is now a penny stock. And since it's recovered, it hasn't really done that much to the triple leverage ETF. So while it made sense that, I'm going to buy into a triple leverage ETF that's going to recover when oil does, it's not the same thing. These are not the type of investment that I would look at for a long-term play. And so the type of people that would do very well trading these leverage ETFs are the swing traders that are looking for maybe a couple days or even just one day, because the longer you hold this, the more likely that the ETF that you're following is going to decay and it becomes pretty much worthless. A lot of the triple leverage ETFs that I used to trade just back at the end of 2018 have been delisted because they decay by so much that they're pretty much worthless. And as I've talked about in the past, there are certain requirements for being listed on the New York Stock Exchange, and one of them has to be a price over $1 for the previous, I think it was like 90 days. And so at this point, UWT was trading for like $50 just a couple months ago, and now it's pretty much worthless. And so you can get around that by having stock splits, but this was one of the ways that I ended up screwing myself over, and I lost 75% of my account because I bought into a 3 times weighted ETF that followed natural gas. And so natural gas spiked, I think it was like the end of 2018. And it spiked to an unusually high level. And I was like, it has to come out of the sky. It's going to have to come down eventually. So I bought the bear 3 times ETF that would do well if the price of natural gas fell. The problem is it kept going up for a little bit, and then it kind of stayed flat. And at that point, my ETF had decayed by so much that it was pretty much worthless. It got to the point where I was doing more harm than good, just kind of waiting to see what would happen. It's called bag holding, where you're holding on to something that's just decaying in value, and you're just hoping that eventually something good is going to happen and you're going to be able to get your money back. You're not thinking about profits, you're just thinking about getting your money back. And I got into this mindset where I was just like, you know what, at this point, what's losing 25% more? And that's just a horrible mindset to be in. And so from that experience, I've learned kind of some risk management, because I put 100% of my portfolio into this 3 times weighted ETF, because I'd always thought that when you're young and you have just not that much money on the line, I think I was only investing with $1,000. I was like, you need to be aggressive, because that's how you really grow your portfolio. The problem was I put all my eggs into one basket. I lost a lot of money, but I learned from it. I think that losing at the beginning of your investing career is one of the best things that can actually happen to you, because even though I lost, I guess it'd be $750, I learned so much from that time about the emotions of stock trading. I learned that it's not good to be super greedy. I was like, it has to fall out of the sky. This seems like a no-brainer play. And I was wrong. And so anytime that you have overconfidence and you're thinking, this seems too easy, you should probably run, because it's probably something that you don't fully understand. Leverage ETFs do look good on the surface, and at this point, the only leverage ETF I would ever buy is going to be TQQQ, because it does follow the market that on average does go up. But if you're going to be following something like a crude, gold prices, silver, natural gas, the volatility is so high and it can just spike or crash in one day, and it can screw you over of a lot of money. Whereas the stock market, it does crash at some points, but we have seen that the leverage ETF has recovered this year. But the longer something stays low, if we had a stock crash back in March where it crashed and it stayed that level for the entirety of the year, the ETF would have decayed so much where it would have been pretty much worthless at that point. You're not going to lose 100% of your money immediately, but just the risk is so much higher that I don't think that buying a triple leverage ETF for a long-term investment is ever going to be a good idea. The only time I would ever buy one of these is if I felt very good about maybe some news coming out. Maybe I thought the vaccine news was going to come out relatively soon and I could buy it for a week or so and see what happened. But I do want to hop on over the charts and kind of explain something important to know that if you are going to be buying these leverage ETFs, because this was one of the mistakes I made at the beginning. I love technical analysis. I love looking at the charts. And I thought I had a very good play set up because of what I saw there. But there is something very important to know about trading these leverage ETFs if you're ever going to consider buying in based off of a technical analysis. So let's hop on over there and I'll talk about what I saw on the charts and how I ended up screwing myself out of 75% of my account. All right, so here's something that I wanted to show off for this leveraged ETF. This is TQQQ, which is the 3 times weighted NASDAQ ETF. And so something I always like doing on this channel is technical analysis. And technical analysis just shows how you can predict future price movement based off of what's happened in the past. And so if I was looking at this, and this is just a normal stock, I would say, oh, it's got a little bit to go until it hits this resistance, so I would not sell if I was trying to make a short-term swing trade on it. So right now it looks good. It looks like it has room to go to the upside. But the problem with leveraged ETFs is that they're not traded by itself. It is following something else. So while it looks like there's still room to go before you hit the resistance at the top, the thing that it's following, which is the future NQ, you can see that it's already past that resistance. So it's important to remember that if you are going to be trading these for short-term plays, to remember to make your decisions on the ETF based off of what it's actually following and not based off of what the charts for the ETF actually looks like. Because based off of what TQQ looked like, it still had room to go to the upside before it hit that resistance. But as you can see here, the way I would have charted this is it's already past that resistance. And so it's just important to know what you're trading and not get caught up on what you see on the charts for the ETF, because I have made this mistake before trading leveraged ETFs on natural gas, where I bought into the ETF because I thought it looked really good, and I kind of forgot that it follows something else, and I ended up losing a lot of money. The story that I just told about being down 75%. So yeah, just important to know what you're trading and what charts you're looking at and what's actually important from the data. So overall, leverage ETFs are a very interesting way to play the stock market. However, I think it's too much risk for most people. The people that are going to do very well trading these leverage ETFs are ones that are going to be day trading or just swing trading for just a couple days, because decay is such an important part of these leverage ETFs that if you're not careful, if you hold on for it too long, the decay is really going to catch up and you're going to lose a lot of money. So this is not something that I would ever put 100% of my portfolio on because I have, and I lost a lot of money, and I'm never going to do that again. But leverage ETFs are very interesting. I think that a lot of people kind of find out about them and get really excited because it makes sense. You know, the stock market returns 10% on average. So triple that, then you go to the compounded interest calculator, and you're going to have 300 million by the time you retire. But there are safer ways to invest in the stock market and still have fantastic returns. But I think leverage ETFs are not a great idea for a lot of people going into the stock market. So let me know if you have any experience trading leverage ETFs, and let me know what stock you guys are watching going into 2021. Thanks for watching these videos. I appreciate all the support, and I will see you on Monday.